Something deeply disturbing is happening inside American brokerage accounts right now, and I don't think most silver investors have any idea it's coming for them. In the last 96 hours, I've received 47 separate messages from people across the United States, Canada, and the United Kingdom describing the exact same experience. They logged into their brokerage account, Fidelity, Schwab, TD Ameritrade, even some smaller regional brokers, and discovered that their silver-related positions had been flagged, restricted. In some cases, completely frozen with a notice saying, "Position review in progress, trading temporarily suspended." These are not criminals. These are not people doing anything illegal. These are ordinary retail investors who own silver ETFs, silver mining stocks, and in some cases, silver futures positions. And their accounts are being frozen without warning, without explanation, and without any clear timeline for when access will be restored. And what's even more disturbing than the account freezes themselves is the specific pattern of WHO is being targeted, because this is not random. This follows a very deliberate logic that I'm going to explain to you today, and once you understand it, you're going to understand why physical silver, actual metal you can hold in your hand, is the only silver position that Wall Street cannot touch. But before I get into the account freezing protocol, I need to give you the current market snapshot, because the numbers today are telling a story that makes everything I'm about to say even more urgent. Right now, Tuesday, April 7th, 2026, silver spot price is $72.98 per ounce, down from the historic all-time high of 121.64 we hit in January. MCX silver in India is trading at R2 32.94 per kilogram, down R485 in early trading. Gold is sitting at $4,680 per ounce, giving us a gold to silver ratio of 64 to 1, which by 340 years of historical data means silver is trading at less than half its fair value relative to gold. Now those numbers are the official numbers, the paper numbers, the COMEX numbers that get broadcast on financial television and quoted on every financial website. But here's what's not being reported. The physical silver market is operating in a completely different reality right now. Generic silver rounds are selling at $6 to $8 over spot at major dealers. Government mint coins are commanding $14 to $18 over spot when you can find them. And certain sizes and formats are simply not available at any price. That gap between paper price and physical reality is the core of everything I'm going to show you today. And Wall Street's account freezing protocol is directly connected to that gap. Let me explain exactly what's happening. When silver hit $121.64 in January, something happened in the brokerage world that got almost zero media coverage. A significant number of retail investors, we're talking tens of thousands of people, started requesting physical delivery of their silver ETF holdings. They didn't want paper silver anymore. They wanted real metal. The largest silver ETF in the world, the iShares Silver Trust, known as SLV, holds approximately 450 million ounces of silver in custodian vaults. When retail investors buy SLV shares, they're supposedly backed by real physical silver. And theoretically, large enough holders can request physical delivery. When tens of thousands of people started requesting delivery or converting paper positions to physical, it triggered what I'm going to call a liquidity stress event inside the ETF custodian system. The custodians, the banks that actually hold the metal, looked at their vaults and realized something terrifying. They didn't have enough immediately deliverable silver to meet all requests simultaneously. COMEX registered inventories confirm this. As of yesterday's report, registered silver, metal available for immediate delivery, stands at 84.7 million ounces. That's down 70% from January 2020. With 7.2 paper claims for every real ounce in the system, the math is catastrophic. So what do the custodians do when they can't deliver? They call the brokerages, and the brokerages implement what insiders are calling the Tuesday protocol. Here's how it works. Brokerages identify accounts that hold significant silver positions, ETFs, mining stocks, futures, and flag them for review. The stated reason is always compliance related. Position size review, risk assessment, regulatory inquiry. But the actual reason is to prevent a coordinated rush to convert paper silver to physical silver that would expose the fundamental insolvency of the paper silver system. Think about what would happen if every SLV holder tried to take physical delivery simultaneously. 450 million ounces of demand, hitting a market where COMEX only has 84.7 million ounces of registered inventory. The entire paper silver system would collapse overnight. The account freezes are a pressure valve. By restricting trading on accounts flagged for review, they prevent large position holders from converting paper to physical during the most critical period of supply stress. It buys the system time. Now, which accounts are being targeted? The pattern I've identified from the 47 reports I mentioned is very specific. Accounts holding more than 500 shares of SLV are being flagged first. accounts that have recently searched for physical delivery options or requested ETF prospectus documents related to delivery procedures, accounts that hold positions in multiple silver vehicles simultaneously, ETF plus mining stocks plus futures, accounts that have made large silver purchases in the last 60 days, and accounts connected to IP addresses that have visited physical bullion dealer websites while logged into their brokerage portal. That last one should disturb you deeply. Your brokerage knows what websites you visit. They track your digital behavior and cross-reference it with your trading activity. If you've been researching physical silver purchases while holding paper silver positions, you're on their list. And you need to understand something critical about what account freezing actually means in legal terms. When a brokerage freezes your account for review, they are not breaking any law. Buried in your brokerage agreement, the 47-page document you agreed to without reading, is a clause that allows them to restrict trading activity during periods of unusual market conditions, or risk review. They can hold your account frozen for 30, 60, even 90 days while conducting their review. And during that time, if silver price moves dramatically, you cannot exit your position, you cannot add to it, and you cannot convert it to physical. You are completely exposed with no ability to act. This is not hypothetical. This happened in 2021 with GameStop. Robinhood froze accounts and restricted buying without any legal consequence whatsoever. The same playbook is being used right now on silver accounts. But here's what they absolutely cannot freeze. Physical silver sitting in your safe at home. Metal you took delivery of and removed from the financial system entirely. Ounces you paid for, received, and stored personally. That silver is yours in a way that no ETF share, no futures contract, no mining stock can ever be. When your brokerage freezes your SLV shares, you have $0 in usable silver. When you own 100 physical ounces, no brokerage, no government notice, no review protocol can touch it. Let me show you the deeper mechanics of why this crisis is happening right now on April 7th specifically. Today marks exactly 90 days since China implemented strategic export controls on refined silver on January 1st. Those controls immediately removed 60 to 70% of global refined silver supply from international markets. China controls between 60 and 70% of the world's silver refining capacity. Not mining, refining. Even metal mined in Mexico, Peru, and Australia often gets shipped to China for refining before being distributed globally. When China classified silver as a strategic material, the same classification they use for rare earth elements, they didn't just restrict their own production. They effectively took control of a massive portion of everyone else's silver supply chain. Now here's the number that should shock you. China imported 206.76 tons of silver in just the first 2 months of 2026, January and February alone. That's the highest import level in 8 years. China restricted exports and simultaneously bought everything they could from global markets. That's not coincidence. That's a coordinated strategic accumulation. They're using their export control leverage to vacuum up global physical silver supply while preventing that supply from reaching Western markets. The 90-day mark matters because international silver supply contracts are typically settled on 90-day cycles. Right now, refineries that had existing forward contracts with Western dealers are completing those contracts and not renewing them. The supply agreements that were keeping Western dealer inventories marginally functional have just expired. This is why dealer premiums started rising sharply in the last 2 weeks. This is why certain products disappeared from websites. And this is why the brokerage account freezes are accelerating. Because the people managing these financial institutions can see the supply data in real time and they know what's coming. Let me give you 3 data points that the mainstream media is completely ignoring today. First, the Silver Miners ETF, ticker SIL, saw its options volume spike by 340% last Thursday compared to its 90-day average. That kind of options surge means institutional players are making very large bets on significant price movement in a short time frame. They're not doing that because they think the market is calm. Second, the lease rate for silver, the cost of borrowing physical silver from vaults, spiked to 4.2% annualized last week. Lease rates only spike when the institutions that need to borrow physical silver for short-term delivery obligations can't find available metal anywhere at normal prices. A 4.2% lease rate is the highest since 2008. When you see lease rates this high, it means the physical market is in acute stress that hasn't yet shown up in spot prices. Third, the Bank for International Settlements, the central bank of central banks, released their quarterly derivatives report last Monday. Total silver derivatives outstanding globally reached $247 billion. Physical silver market capitalization at current prices is approximately $47 billion. That means paper silver derivatives are 5.25 times larger than the entire physical silver market. Every single dollar of real silver has $5.25 of paper claims attached to it. When those paper claims try to convert to physical simultaneously, the math produces one result: complete market failure. Now, let me address the geopolitical dimension that's creating the trigger for all of this today, Tuesday, April 7th. The Trump administration issued a formal deadline to Iran yesterday, April 6th, regarding nuclear negotiations and regional military activities. That deadline expires today. As of the time I'm recording this, Iran has not responded to U.S. terms. The probability of military action in the Persian Gulf this week is being assessed by defense analysts at somewhere between 35 and 55%. Here's why this matters to silver beyond the obvious safe haven argument. Iran sits on the Strait of Hormuz. 20% of the world's oil transits through that 21-mile wide choke point every single day. If the strait is disrupted by military conflict, oil prices spike immediately. But the less reported consequence is what happens to global shipping insurance rates. When the Strait of Hormuz becomes a war zone, Lloyd's of London and other marine insurers immediately add war risk premiums to any vessel transiting the region. Those premiums can triple or quadruple shipping costs overnight. And a massive percentage of silver's global supply chain, from mining to refining to distribution, relies on maritime shipping through or near that region. Mexico ships silver through Pacific routes, Peru routes through Panama, Australian silver crosses the Pacific. But much of Asia's refining and redistribution happens through routes that pass near conflict zones in West Asia. Even indirect disruption to shipping insurance costs can freeze the supply chain for weeks. Add a Strait of Hormuz crisis on top of Chinese export controls, on top of COMEX inventory depletion, on top of the U.S. mint supply emergency, and you don't have a silver market anymore. You have a physical silver famine. And the brokerage account freezes are the financial system's early warning response to exactly this scenario. Let me tell you what happened to silver during the last time we had simultaneous supply crisis and geopolitical escalation. In 2011, during the Arab Spring, when multiple Middle Eastern governments were collapsing simultaneously, silver went from $26 per ounce in January to $49.51 per ounce by April 28th. That's a 90% gain in 4 months. But here's the critical difference between 2011 and now. In 2011, COMEX silver inventories were healthy. China was not restricting silver exports. Industrial demand from solar was a fraction of current levels. Mining production was stable. The silver market in 2011 was fundamentally sound, but experiencing speculative mania. The silver market in April 2026 is experiencing the 6th consecutive year of structural deficit with depleted COMEX inventories and weaponized Chinese supply controls and physical dealer shortages, and now brokerage account freezes. The underlying condition is catastrophically worse. The price move potential is correspondingly larger. When Keith Neumeyer, CEO of First Majestic Silver, said, "We've created a new pricing paradigm and we're not going back to old prices," he was describing exactly this structural shift. The world's largest primary silver miner is telling you that the cost basis for silver production has permanently changed, that supply constraints are permanent, and that prices from the pre-2025 era are gone forever. When Alan Hibbard at goldsilver.com forecasts $175 silver and says he expects 2026 to outperform 2025's 147% gain, he's looking at the supply deficit data, the Chinese export controls, the COMEX inventory exhaustion, and the irreplaceable industrial demand, and doing basic arithmetic. Even JP Morgan, who has historically been one of the largest silver short sellers in COMEX history, is now forecasting $81 average silver price for 2026. When the institution that profits most from lower silver prices turns bullish, that tells you something profound about where the market is actually heading. Here's what you need to take away from everything I've shown you today. Paper silver, ETFs, futures, mining stocks held in brokerage accounts is subject to account freezing, trading restrictions, forced liquidation, and custodial failure. The Tuesday protocol is real and it's active right now. If your silver exposure is entirely in paper form inside a brokerage account, you are one review notice away from having zero ability to act on your position during the most critical market movement. Physical silver, metal you personally hold outside the financial system, cannot be frozen, cannot be restricted, cannot be subject to custodial failure. When COMEX defaults, when ETF custodians can't deliver, when brokerages freeze accounts, your physical ounces are unaffected and will represent the only real silver available in the market. The premium you pay for physical silver today, $6, $8, even $12 over the $72.98 spot price, is not a cost. It's an insurance payment that guarantees your silver exists in reality rather than on a computer screen that can be frozen by a compliance department. The gold to silver ratio at 64-1 is telling you silver is deeply undervalued relative to its monetary peer. 6 consecutive years of supply deficit are telling you physical stocks are being exhausted. Chinese export controls are telling you the largest refining base in the world is now a strategic weapon aimed at Western supply chains. And 47 reports of frozen brokerage accounts are telling you the financial system is activating emergency protocols to manage a physical supply crisis it cannot publicly admit. India's MCX silver opened at Rs $2,032,000 and is trading at Rs 2.194 today, with physical premiums in southern cities running are 10,000 per kilogram above national averages. That regional premium in India is the preview of what's coming to Western physical markets. This is the Hidden AG, Tuesday, April 7th, 2026. The Tuesday protocol is active. Your paper silver is at risk. Physical ounces at $72.98. Spot, plus whatever premium you can find, are the only silver that actually belongs to you. The window between now and when the general public understands what's happening is measured in days, not weeks. Act accordingly.